Is it true that the current Canadian federal government's strategy is to rein in operational deficits, not through reckless austerity, but by tightening day-to-day spending growth while deliberately borrowing to fund productive, nation-building capital investments that strengthen Canada's long-term economy? This question goes to the heart of Canada's new fiscal direction. After years of pandemic-driven deficits and high inflation, the federal government has re-engineered its budgeting framework. Rather than pursuing austerity, it seeks to stabilize operational spending while using targeted borrowing to finance capital projects designed to build long-term economic strength. Yes, it is broadly true. The 2025 federal budget confirms that the government's priority is to stabilize or reduce its operating deficit, the cost of day-to-day programs, while channeling new debt toward capital investments that grow productivity, strengthen housing, and modernize infrastructure. This marks a deliberate shift from short-term relief spending to long-term nation-building. The budget states clearly that Canada aims to balance daily operating spending with revenues by 2028 to 29, while maintaining a declining deficit to GDP ratio. It introduces a capital budgeting framework to separate routine expenses from growth investments, ensuring borrowing is focused on tangible assets and innovation. Over 5 years, about 280 billion Canadian dollars in accrual terms, roughly $450 billion cash, is allocated for infrastructure, housing, productivity, competitiveness, and defense. At the same time, a comprehensive expenditure review targets $60 billion in savings by improving efficiency across federal operations. Although the budget does not publish a precise return on investment ratio, it projects strong economic effects. Real GDP growth is expected to rise from 1.1% in 2025 to around 2% by 2027, driven by the productivity boost from infrastructure and innovation spending. Public investment is expected to leverage as much as $500 billion in private capital, creating a multiplier that amplifies the impact of public spending. Program spending is projected to grow at about 3% annually through 2030, yet the debt-to-GDP ratio should stabilize near 43%, as higher productivity and revenues offset borrowing costs. This represents a fundamental change in Canada's budget philosophy. Rather than treat all deficits as equal, the government is distinguishing between bad debt that finances operations and good debt that builds productive assets. Each borrowed dollar is expected to yield a return greater than its interest cost by creating future economic capacity, more housing, stronger supply chains, and better industrial productivity. If executed well, this strategy could make Canada's debt more sustainable over time. The success of this approach depends heavily on execution. Projects must be efficiently managed and publicly transparent. The line between operational and capital spending must be clear to avoid misclassification that could erode credibility. The government must also realize operational savings without hurting service quality. Independent analysts warn that overestimating returns or masking program costs as capital investments would undermine public trust and fiscal discipline. In summary, the federal budget confirms a strategic pivot toward stabilizing operational deficits while borrowing for productive capital investments expected to enhance productivity, employment, and long-term competitiveness. It is a measured approach, not austerity, but discipline with purpose, aimed at transforming short-term borrowing into lasting national value. That is exactly the policy direction set out in Budget 2025, discipline on operations and ambition in capital investment. The real test will be transparency, execution, and proof that Canada's investment truly pays dividends for future generations. The goal is a Canada that grows its way to fiscal strength instead of cutting its way to weakness. Canada. Department of Finance, 2025. Budget 2025, a stronger Canada through investment and discipline. This is the core reference confirming the government's plan to balance operations by 2028 to 29 and direct new borrowing toward long-term capital projects. CPA Ontario, 2025. Federal Budget 2025, highlights and takeaways. Summarizes key fiscal measures and explains how the budget controls program spending while promoting productivity and infrastructure growth. Deloitte Canada, 2025. Federal Budget 2025 commentary. Provides expert analysis on investment priorities, private sector leverage, and the fiscal impact of capital budgeting. Fraser Institute, 2025. Pulling back the curtain on the federal government's first budget. Offers an external check on transparency and accountability in how spending is classified and reported. OECD, 2025. OECD Economic Outlook, Canada. Supplies global context and comparative data on growth, debt ratios, and fiscal sustainability. Viewers can pause here to review the full citations and follow links to the source material. There is more fact-checking information to discover.